Hello and welcome to Market Domination. I'm Josh Schafer in for Josh Lipton, live from our New York City headquarters. It's the last trading day of the week and stocks are rising on investor optimism around the future of the Federal Reserve and that U.S. interest rates may fall further this year. We're also seeing gold hit a record high in the wake of a surprise tariff. We'll have more on all those market moves, but right now, there's just an hour to go until the closing bell and stocks are higher. We are on record watch today with the S&P 500 hovering right near an all-time close. I believe the NASDAQ is also in similar territory. That tech-heavy NASDAQ up about 1%, the S&P 500 up about 0.8%, and then your Dow Jones Industrial Average is up over 200 points, or about 0.5%. Let's welcome in Tim Urbanowitz, Chief Investment Strategist at Innovator Capital Management, and our Data and Markets Editor, Jared Blickery. They're both going to be joining us throughout the show to break down all these headlines. Jared, I want to kick it over to you first. What's moving in the market today?
Yes, we got the major indices up here. As you said, the Dow Jones up about 0.5%. And let's just check out the intraday price action. We actually hit the highs very early in the session, just kind of chopping around here recently. I think investors will take it. I'll show you real quickly the 5-day look, excuse me, up 1.41%, pretty much holding these gains the entire week. Here's the NASDAQ. You can see it's up to 4%, hitting the highs right here today. We've seen a lot of strength on the mega caps, and we'll check out the NASDAQ 100 in just a little bit. S&P 500 also tacking on gains to the week, up about 2.5%, and not to be left out, the small caps. Russell 2000 also up about 2.5%. Quick check on the bond market. We've got yields, longer-term yields, just a little bit up, 4 basis points. 10-year up to 4.28%, the 30-year up to 4.85%, but still well off of that 5% mark that was kind of causing a little bit of a hiccup in risk markets the last few weeks. And the U.S. dollar index over the last 5 days, it is net down, including today. So let's skip on over to the sectors and see what's moving inside the market. Financials in the pole position, kind of jockeying with tech, though they're both up almost 1% there. Healthcare is also outperforming the S&P 500. To the downside, we've got utilities and real estate. Those are both down about 0.5%. Both of those are interest rate sensitive. And I did note that the longer-term bond yields were up just a smidge today. And checking out the NASDAQ 100, we see some outperformance from some of the mega caps. Apple up 4%, Alphabet up 2%, Tesla up 2%. And I'll just quickly show you a 5-day view. Look at that, Apple up 13%, Tesla up 9%. So we have seen a lot of contribution from these names throughout the week. And I'm going to real quickly show you our leaders. And this is also a weekly look. What I want you to see is that the Mag 7, that's that MAGS ETF, up 5.6%. But ARK, which typically has smaller components in it, that's up 5% as well. Not a lot of losers here, most of those centered on biotech. So it's been broad-based strength for the week. I'm going to dial this back down to a daily look, and this is the Dow, and I'll end here. We got Visa up 1%, J&J up 1%, kind of some broad strength throughout a lot of these sectors. Energy not so strong. We're seeing Chevron up 1.3%. It has been weaker earlier this week. And then IBM, that is taking a hit of about 2.3%. Josh?
Tim, I want to kick it over to you. Of course, Jared just pointed out seeing some more strength in tech today, specifically some strength in Apple really across the week. I mean, what stood out to you about the action that you've seen as throughout the week, as we're probably going to close higher on the week here?
Well, Josh, I think tech is all about earnings right now. You look at this earnings season so far of the S&P 500 tech names that have reported, over 90% of them have beat estimates. That is very strong. That is stronger than any other sector that we are seeing within the S&P 500. There is a lot of momentum here. Obviously, you're getting a lot of the tailwinds from the AI narrative there as well. But we continue to think tech is a place that you want to lean into. A lot of these companies are going to be insulated, especially the software companies, from the tariffs. So it's a sector that's doing very, very well. And I think the earnings are really backing that narrative.
And Tim, I want to ask you about another headline that we got this week. Of course, there's been a lot of talk about the future of the Federal Reserve this week, right? Who's going to replace Fed Chair Powell? We now know who the new governor will be. How do you think that's been impacting markets? It seemed like markets actually moved a little bit lower when there was a report that perhaps Christopher Waller is leading that charge, but I thought maybe that would be a buoy for markets. How have you been sort of digesting those headlines?
Well, Josh, I do think it's all about the candidate. And I think the most important thing here for markets is that we get a candidate that is going to cut rates at the right time for the right reasons, and not someone that's just going to go out there and just bow down to whatever the president wants, these huge cuts. That's going to scare the bond market. That's going to scare the equity market. And right now, if you look at who's leading the pack, we do think Waller is probably in the lead for a couple of different reasons. One, I do think he takes this approach of more forward-looking. Let's get in front of this, as opposed to just waiting and seeing the data that comes in, which I think the market will like. But he's also not someone that's going to go out there and just cut to cut if we do see a different narrative playing out. And from the president's perspective, who wants rates lower right now, I think that's an important candidate for him because he has a seat at the table, and he almost would be operating as a shadow Fed chair until Powell's term is up. So we see him as the front runner because of that. And we do think that he's a candidate the market will end up liking just for that more reasonable forward-looking approach.
Tim, we've seen markets rise whether we're pricing in more interest rate cuts or less interest rate cuts, right? In the past week, it's been markets are now debating 2 or 3 cuts. You think the market needs 2 or 3 cuts to keep chugging higher, or could we move away from that narrative and stocks could still move higher?
Well, I do think we can move away from that narrative. One of the things that we are focused on is the labor market. I know, we think we saw a little bit of an overreaction in the stock market after those job revisions. But Josh, we actually view that weakness as a good thing long term. Okay. Yes, you might see some volatility in the short run. Yes, there might be some pain in the short run. But at the end of the day, everybody wants interest rates down. We want inflation down. Well, guess what? The labor market holds the keys to that. And if we keep running as strong as we have been with wages going up as quickly as they have been over the last couple of years, it's just unrealistic to think that we're going to get inflation down to a more reasonable level. It's unrealistic to think that we're going to get interest rates down. So we're welcoming some of this softer data, and we don't think there's anything out there that's cause for panic right now, which is very important. And by the way, Josh, because we have this big, beautiful bill coming with all the tax cuts, we think that provides some insulation moving forward from any of those major moves that would be detrimental to the equity market longer term.
Sure. Well, Jared, we're going to see you back at the close, but Tim, I'm going to have you stick with me here. We're going to keep chatting a bit more on these markets because, again, stocks are ticking higher as the markets look to round out a winning week. Markets have been largely uninterrupted by President Trump's new tariffs, which took effect earlier this week. Next week, we'll get fresh inflation data and some Fed speak. Our next guest is tracking all of that when it comes to the economy. Joining me now is Michael Kelly, PineBridge Investments Global Head of Multi-Assets. Michael, I want to start with sort of the macro narrative that we're dealing with here. We did get a lot of tariff updates this week, and it seemed like the market kind of just looked through them again, even though there are perhaps significantly more tariffs going or higher tariff rates going to countries. How have you been digesting those headlines and what they mean?
Well, I think the market is when you've worried about something forever and there's no tangible evidence, people begin to dismiss the headlines. I think we are coming into a higher step up in tariffs. It will lead to higher goods-related inflation, but importantly, imported goods, which is only 12.5% of the consumer consumption pie. Domestically produced goods, another 12.5%, doesn't relate to those. The other 75%, the big kahuna, is services. And so you can be and should be appropriately worried about goods prices starting to really go up for the next 6, 7, 8, 9 months. Having said that, services are continuing to disinflate, and they're much bigger. And this is, Tim was mentioning AI. This is where AI comes in. The unemployment rate for computer scientist degrees out of undergraduate is now up to 30%. Mm-hmm. You have big tech companies that are beginning to say, well, our business is still really good, but we don't need as many computer scientists and engineers. We have AI doing that. And we're hearing a lot of use cases beyond tech companies that, a year or two ago, this ChatGPT, just a cute little thing.
Sure.
Now we're seeing really use cases beginning to kick in. So that could start driving margins very materially fairly soon.
And how do you sort of express that in the market then, right? That broadening of the AI
you stay, the biggest thing is early this year, the markets turned away from what they called U.S. exceptionalism. Since the COVID crisis, what the U.S. was particularly exceptional about was fiscal thrusts. We had CARES Act 1, CARES Act 2. Each were 7-8% of GDP. Unbelievable. And then we were followed by the infrastructure. So industrial policy, but we were at least active when others were inactive, and it was a differentiator. Now, it's a very different world. We see the market actually being driven more, even though there's a macro headline, policy headline every single day. We see as AI grips, it's going to turn much more micro. And while China's getting back into the act in technology, right now, if these use cases prove as effective as we think we will be, as soon as they will be, to source those, there's only one place to go in the world. So this anti-US centricity that the year started with, we think it's going to end with, and next year is going to turn back to a US centricity, which will be not just an AI centricity, but what it does for business models. If you're a data-rich business model, AI is just the most wonderful thing in the world. You'll be able to boost margins. Other companies will be able to gain share, global share. So, we think that you want to start leaning into US centricity in the equity markets.
Sure.
In the fixed income markets, it's the opposite. The tariff goods-related pricing here is going to morph into disinflationary tendencies elsewhere. And those central banks are almost done with their policy rate cutting, which that's actually in the environment we're in a threat to the long end of the bond market. We're going into another phase of that threat to the bond market. It matters very much who you put behind the seat, as Tim was saying. But
and I'm curious, Michael, you had an interesting, it was really the title of one of your most recent announcements I was reading. There's going to be dips, but you're buying those dips, and I believe you're talking about the U.S. equity market.
Yes.
Why are you buying the dips?
Well, because you should be constructive on, if you were looking at the locomotive for the first time, the railroad for the first time, electricity for the first time, the internet for the first time. What followed that was a period of picked up growth, but because this was supply-led growth, it was not picked up inflation. People are brainwashed, faster growth, faster inflation. Supply-led growth is not that. And the internet has the promise of being another wave of supply-led growth. So more growth, not more inflation, very, very good things. So that's why, if we do have scary headlines as these goods-related tariffs come through, or you want to use every one of those as an opportunity as before the U.S. centricity comes back to markets in full force, we think, by next year.
And is there any part of the strategy right now where you are hedging to get a little bit defensive, given, we just mentioned it, we're back at record highs for the S&P 500, right? There's plenty of things that feel a little go-go in this market right now, whether it be IPOs surging, meme stocks, et cetera. Is there room to be defensive, and how would you kind of express that stance?
Well, we're expressing we're sort of neutral risk posture. We love the intermediate term. We're a little bit worried about what you're saying in the shorter periods. But the most important thing is to remember your portfolio has to have some combination of very margin resilient companies. So we have a particular portfolio because we think margins will be under pressure for the rest of this year, even though they're not evident at the moment. And you want to combine that where the secular strength is going. So things like, AI power. You can't get electricity had been growing at 1% a year. It's now going to be growing at about 3% a year. How do you fulfill that power? Mostly nuclear, because it's very smooth power. But there's so many permutations of what's happening with the AI build-out and what comes after the pickaxe and shovel stage of the AI build-out into applications, agentic applications, taking every software installed base, hooking up with agentics, and you have a big, huge upgrade cycle ahead of you. So you want to lean into it with a combination of all of those. And there's actually just a lot more going on in the world, not just the US, than there was a year ago. Germany removed their debt brake. That was slowing Europe for 20 years. It was just removed. That's a great thing. The fact that China is actually getting back, the glass ceiling's been removed for them, for their internet companies to start chasing ours.
Yeah.
It's actually a good thing. It's like the Olympics. Everyone runs further. Yeah.
I like that, the Olympics. Plenty of potential winners then, right, Michael? We're going to have to leave it there. Appreciate you coming in the studio.
Sure. I see you.
Well, the world watched President Trump move forward with a slew of new tariffs built around recent pacts with major trading partners. Still, many details remain cloudy. Washington correspondent Ben Werschel joins us now to help put those deals into context. Ben, a lot of deals this week, a lot of headlines, which I know has been the cadence for a while now. What do we actually know about some of these headline deals that we see and sort of the details, if we do have any details on the deals?
That's precisely the issue there, Josh. We don't have a lot of details on that. And that's what I've been interested in today, is that this kind of parallel tracks we've been seeing on the trade front this week. On the one hand, as you mentioned, we have these reciprocal tariffs that are now in place, built around 10 to 20% duties on countries that have a deal. On the other side, on the parallel track, we have these deals that are under increasing confusion. Basically, what's in them? We don't have legally binding text on any of them. We don't even have joint statements on a lot of them. And what we've seen is a lot of issues arise on what's there. The main one is whether these rates that we're seeing that went in place this week are all inclusive. In other words, does a 15% deal with Europe mean 15% on semiconductors? Does it mean 15% on pharmaceuticals and autos? Even the White House fact sheet on the deal says yes, but a variety of actions and words from the Trump administration this week have raised questions. We even saw the Japanese trade negotiator make a quick trip to Washington this week, basically to get reassurance on that front. He came out saying that he's confident it's going to be resolved. This is a sort of temporary issue, especially on autos. That's a giant issue for him. After all this negotiation to get it down from 25 to 15%, at the moment, the tariffs are still at 25% on autos. The other aspect of this is these investment deals that we're seeing in there. Trump describes them as a blank check for him, basically for him to decide what to do with, a pot of money. These other countries describe these very differently, more like a financing fund. This is all important because a third aspect of these deals is Trump constantly saying he reserves the right to change any terms he wants if he feels unhappy. He can raise the rates if he wants to. He says he has the right to do that if this isn't working out to his liking. So the bottom line for folks is that even though we have all these deals and we've had all these high-profile announcements, these are very fragile agreements, as we are still waiting on legally binding text, which by all indications is still being worked out on all these fronts. I think a very particular telling quote came from Japan this week. This is one of the countries that's in the middle of this. Their prime minister has been under had a lot of questions domestically on this, and according to the Washington Post report, was meeting with lawmakers to try to mollify them. And he reportedly talked about how dealing with Trump is particularly challenging, and added that, quote, in negotiations like this, implementation is far more difficult than reaching an agreement. In other words, we're going to be talking about how these work out for a long time to come.
Ben, you just hit on what I feel like is, of course, the question of the moment. I know it's hard to answer, right? But is there any sense of timeline? I mean, at some point, we have to get details, right, for these tariffs to stay in place and be doing what they're supposed to be doing. There would have to be clear details at some point in the process.
Yeah, there is progress on some. As an example, the UK had their first deal, and we do have a little more detail there. We don't have the full text yet, but we have more there. Indonesia is another example where we have a joint statement, which is a key step in this. Others are further along. So I think they will continue to progress slowly, but the key thing is that we kind of have front-loaded this with the tariffs going into place, and now we're kind of filling in all the back details there. So it could be a lot more changes in the head as they sort of work out these a lot of big important issues going forward.
Plenty for us to keep tracking. Appreciate you joining us today, Ben.
Sure thing.
Some breaking news now. The head of the Internal Revenue Service is reportedly being removed from his post by President Trump. The New York Times reports Billy Long is out after just a short 2-month stint as commissioner. Long is a former Republican congressman and staunch ally of Trump. It is unclear who will lead the IRS next. It's worth noting that the agency has had 6 different people in charge this year alone. Treasury Secretary Scott Bessent will serve as acting commissioner until a permanent replacement is in place. Long had been an unlikely candidate to lead the IRS, not having a background in tax policy. Beyond promoting a tax credit that the IRS has warned was riddled with fraud, while he was in Congress, he supported legislation calling for the abolition of the agency entirely. Tim, I want to bring you in here. Just thoughts on this headline, sort of how you're digressing that news.
Well, it's not much different than the first time around with Trump, right? He wants A players in A spots, and I know the market was really into what was going on with the BLS and replacing the BLS chief earlier in the week. We think that's really important. Obviously, the data that we're getting there that people are relying on to make investment decisions needs to be reliable, and we need to have clearer payrolls data. So I don't think this is going to have a huge impact. I don't think it's going to move the markets a ton. Obviously, the tax breaks and tax credits that have already been pushed through are going to be really important. We think that continues to drive the consumer, help support the economy moving forward. But who's in charge of the IRS? I'm not sure that's going to have a big move one way or the other.
Tim, you pointed out that we are starting to see the trend that was certainly familiar in Trump's first term, right, of moving around a lot of these officials, and people are in and then they're out. And I'm curious if that spreads and this becomes sort of a broad trend like it was the first time around. I mean, is that a concern at all for markets, just given potential uncertainty that maybe that would build if there's a lot of moving around when it comes to different areas of this administration?
Well, I don't think so in areas like this. At the end of the day, there's a lot of pro-growth policies that are out there that Trump has pushed, that he continues to push. And I think that's what the market is going to stay focused on. I think when we look at this right now, I do think there is a level of complacency that has set in, particularly around tariffs. And just confusion around what Trump's ultimate goal is. When we take a step back and we look at this, the goal is higher tariffs. And right now, we look at what rates have been proposed versus what was proposed post-Liberation Day. We're at about 2/3 of where we were post-Liberation Day. So, I do think investors have become a little complacent on certain policies, particularly around tariffs. And right now, this idea that the economy is just going to digest these tariffs very well and the market is going to look through it. I don't think you want to make that assumption. I think especially given where this market is trading right now, you want to look to make sure that you have some risk management and some stability in your portfolio, because we're going to see what that jump in tariffs looks like. Even just from where we were at in June, what was actually collected in June, we're going to be about 7-8% higher. The effective tariff rate, 7-8% higher than where that was. So the jury's still out. We don't want to get complacent. We want to make sure we're on our toes. We're managing risk in our portfolio well.
All right, Tim, you're going to stick with us because we're just getting started here on Market Domination. Coming up, Tim Cook is back in President Trump's good graces, but it wasn't always the case. We're taking a look at that dynamic, plus a look at an encouraging week for the iPhone maker. Chip companies are investing in the U.S. to satisfy Trump's efforts to bring manufacturing back to the United States. We're going to take a deep dive into those wins and losses and what a difference a day makes. Firefly Aerospace's shares are sliding after a blockbuster IPO. We'll be taking a look at what's driving that action. Stay with us. Apple stock getting rewarded this week after President Trump and CEO Tim Cook announced that the tech giant is making an additional $100 billion U.S. manufacturing commitment. And I want to take a look at how shares have performed this week. So Apple now up 13% on the week. It is up another 4% today. And what's interesting with this Apple move, of course, this main move coming Wednesday after Tim Cook and President Trump were at the White House on that day, and the rallies really sort of continued. But what's interesting in this move with Apple is if we zoom out on the year and we talk about this Mag 7, this big tech rally that we've seen for really 2 years now, but you take a look at a year to date at Apple Apple had not been participating in this rally. Apple was down more than 15% on the year, a clear laggard among big tech. Now it's starting to come up positive. Our friend Jared Blickery has pointed out that a 215 level on Apple was a very interesting remembrance point for investors. Apple has surged past that. Now that, of course, begs the question of if Apple can get back to positive this year and keep rallying. And I do want to bring in our Yahoo Finance tech editor, Dan Howley, to break this down a little bit more. Dan, just interesting to see the move in Apple this week. Of course, shares reacting well to this investment. I mean, how does this sort of add to their overall U.S. investment, and how have you sort of made sense of the Apple story this week?
Yeah, it does add to their U.S. investment. They obviously are pushing this, building in America kind of narrative. And yes, they are investing in America. They're going to be doing certain things in America. They're not building the iPhone in America. That's not going to be happening. They're going to continue to build that overseas, but they are sourcing more or investing more in some of their supply chain partners in the U.S. That includes things like Samsung, Corning, what have you. This is really a move, a strategic and political move by Apple. They were under the gun when it came to the relationship with Trump. There was calls for them to build in the U.S. There were discussions on, I think at one point Peter Navarro had gone on CNBC and said that it was the biggest soap opera in Silicon Valley that the company couldn't build in the U.S. Experts that I spoke to said, no, it really is an untenable question to ask them to build in the U.S. now, at least within the next 4 years. The issue being that the supply chain isn't there, the workers aren't there, the skills don't really translate. There was an article in CNN discussing how Motorola had tried to have its own plant in the U.S. where they were building smartphones, and that folded in a year because the workers just had the choice between working in a factory, having to develop skills, or working in the restaurant industry. And it's, the question was, okay, what's going to take more time to learn? And so that was an ongoing problem. They had initially said they were investing $500 billion in February. Then the idea of building in the U.S. became an issue, especially around the time the tariffs came out. Tim Cook had kind of made the idea to move U.S.-bound iPhones out of China and into India to get around those tariffs. And the Trump administration didn't really appreciate that. And that's when you had these calls for Apple to build in the U.S. There were some remarks that Trump had made about Tim Cook saying that he wasn't very happy with him at certain points. And so you have this $100 billion investment, this meeting at the White House. And then the same day, President Trump had said at that meeting that he was going to be doing the 100% tariff on semiconductors unless companies build in the U.S., and that Apple would likely avoid that tariff because of the moves that it's making. So obviously, Tim Cook is a smart executive. He's been the CEO for Apple for years because of that. And this is just kind of the latest show of that kind of gamesmanship that he's able to work through.
And Dan, it hasn't just been Apple, of course, that's made news coming out of the White House this week. It's really been the broader tech sector, which of course you cover. So I want you to stick with us for this next discussion too, because chip companies have been making investments in the U.S., and that's to fulfill Trump's efforts to bring manufacturing back to the United States. Otherwise, Trump threatening a 100% tariff on imports of semiconductors. We're combing through those complexities of the semiconductor supply chain as chip companies navigate those tariffs. Amid that strong AI trade, we're bringing in Jay Goldberg, Seaport Research Partners senior analyst, joining us now to discuss this. Jay, I want to start with just the 100% tariffs, but maybe not 100% tariffs. It depends on what kind of chip it is, and it depends on what company you are and where you're making things. What do you make of the back and forth on chip tariffs this week, and was there anything to take out of it that's sort of actionable?
Honestly, I'm as confused as everybody else. I was listening to your previous guests talk about it, and they're experts in tariffs, and they don't seem too clear on the details either. I'm just a humble semiconductor analyst, so I'm as confused as everybody else. I think when I talk to companies, management teams, they know they just have to be flexible and be ready to change tack at any point. I think the assumption is that we'll find some new normal. Tariffs will be higher than they used to be, but not as high as those really high punitive levels.
And Dan, I want to bring you in here too. You're still with us because there was also, of course, there's so many chip headlines. We haven't even gotten to this one yet, which was really sort of the eye catcher, right? You had President Trump coming out on Truth Social, calling for Intel's CEO to step down. But Intel's been investing in the U.S. quite a bit, right? So what's sort of the history there of Intel trying to make an effort to perhaps be on the president's good side?
Yeah, I mean, this has been something that Intel's been doing for some time. These investments in the U.S. Obviously, they're the U.S. marquee, marquee U.S. Chip maker. They're the ones that build the most chips. They have some of the most advanced chips for U.S. manufacturing. They've struggled obviously with TSMC being in the lead, but Intel continues to invest in the U.S. Underneath the Biden administration. As part of the CHIPS Act, they promised to build out that massive facility in Ohio. They obviously have factories over in Oregon as well as in other areas of the U.S. They continue to try to expand their footprint and expand their ability to produce chips and research chips. There's problems, though, now with the finances where they're not able to necessarily meet those ambitious goals that they had for that build out. But Intel is an important company for the U.S. in and of itself, let alone the amount that it invests when it comes to continuing to try to build those factories and research centers.
Jay, sort of tying all these headlines together, I mean, where are you seeing the opportunity in the chip space right now?
So, I mean, the easy answer right now is AI. NVIDIA is the obvious name there, but there's lots of other companies that are participating in it. Broadcom, Marvell, the memory companies. There's a lot of AI. The AI spending wave is immense from the hyperscalers. So anyone who can touch that is doing well. I think Intel is the real standout here. They don't have an AI strategy. They're in a lot of trouble now, and it's a pretty glaring absence for a company that was once the flagship of American semiconductor companies.
And Jay, we haven't heard from NVIDIA yet, right? We've heard from most of these chip companies at this point. That's going to be coming later in the month. That stock's now at, I'm looking at my screen, $182 a share. It's been a crazy rally off that April bottom. Is the rally overdone at this point going into that earnings print?
Yeah, I mean, I'm fairly cautious on NVIDIA. I think that the upside is largely priced in. They've said they're sold out for the year. There's a little bit back and forth with what they can ship to China, but beyond that, they're kind of capacity constrained. And so the scope for further upside is limited. I mean, I wouldn't go out and short it, obviously, but I think it is going to underperform the broader sector.
Dan, I'm curious, as you think ahead to NVIDIA earnings and you parse through what we've heard from some of these chip companies, I mean, what's the number one thing that's sort of on your eye that you're thinking about over the next couple of weeks?
Really, I mean, when we get the notifications about those China shipments that they're able to start up again, right? They took that $4.5 billion hit in the prior quarter. I think they said this quarter it was going to be $8 billion. Might have to check my math on that exactly, but the time that they're able to start shipping that will help them address those prior shortfalls or the coming shortfall. And I think that's what a lot of Wall Street is looking at. And that, and okay, so we have Blackwell. Obviously it's Wall Street, so it's what have you done for me lately? So the ramp of Blackwell Ultra will obviously be very important. Then for Vera Rubin, their next generation setup will also be very, very important for them. So those are some catalysts down the line. But for now, I think that most Wall Street's obviously very happy from that April low was when the China order came out. Wall Street kind of freaked out and said, well, there's a problem. They're not going to be able to ship this into this country. NVIDIA, kind of said, okay, we're going to stop. Some analysts said, well, now China's zeroed out. It's okay. So you started to see NVIDIA rise and obviously hitting that $4 trillion mark. And then, the idea of sovereign AI has been really big for them. But I think just getting back that China market is incredibly important and something to watch. The one thing I'll caveat that with is they were out of the market. Now there's questions of, will they continue to be in the market? Will people who want access to those chips in China be able to continue to access them? Or will those people then just go and look for local competition that's got a more stable supply line? So, it's kind of a win-lose situation almost, where you have, sure, you're back in China, but it still raises that question of, are you going to be able to stay there?
Jay, what do you make of that point from Dan, sort of the question mark when it comes to China for NVIDIA?
I think China's obviously a crucial market for AI right now. They have immensely advanced software capabilities. And NVIDIA has been doing pretty well there. AMD is also in a similar bind with restrictions and now no restrictions. So there's huge demand in China for US chips to run AI. I think if we go down a very trade war, bleak trade war scenario where tensions rise, China does have domestic chip capabilities to build AI chips. Huawei in particular has a pretty interesting looking chip. They're just limited in their ability to access manufacturing at TSMC and other advanced nodes. And so it's one of these things where it seems to be a national imperative for China to build out its capabilities. If push comes to shove, they have alternatives. They're just not great ones. Most of the software companies in China that I talk to would much rather have access to NVIDIA. And I think, it's one of these things where it's good for the company. It's probably better for America if NVIDIA can sell and AMD can sell into China, because the alternative is if they get blocked, China will eventually find substitutes. They'll find alternatives domestically, and that's not good for the U.S. industry.
Jay and Dan, we're going to have to leave it there. Appreciate both you guys joining us today.
Thank you.
Coming up, we'll be breaking down some of the top trending tickers of the day. Plus, is cosmetics maker e.l.f. having a glow-up moment? The CEO joins the program to break that down for us. We'll have much more market domination on the other side. Now time for some of today's trending tickers. We're watching shares of CoreWeave and Firefly Aerospace. Starting off with CoreWeave. Those shares are rising ahead of second quarter earnings results that are coming up Tuesday after the closing bell. Analysts expect an improvement in the company's orders as customers like Microsoft, Google, and OpenAI spend more on AI infrastructure. We can also expect to hear about the pending Core Scientific acquisition on that earnings call. And I do still have Tim here with me. And Tim, I want to talk to you about CoreWeave and sort of this trend that we're seeing with AI, of course. That's been a stock that's rallied off that AI hype. I mean, how do you sort of parse through different AI names, right? There's so many options, and how does a name like CoreWeave fit into like an AI portfolio strategy concept?
Yeah, Josh, well, when we look at a name like CoreWeave, I'm looking at this down 30% from the highs. And a lot of concern going into earnings about what does their capital spend look like? What does the guidance on that capital spend look like? And if you see any weakness related to that, if those numbers come in higher than expected, we would view CoreWeave as a name we would want to continue to add to, just given the growth prospects. I mean, if you look at the demand from Google, from OpenAI, the demand is off the charts. Okay, and they're going to be pulling a lot of this spending forward to meet that demand. Yes, that might be problematic short term, but long term, that type of demand is something that we would want exposure to. So, we've been very bullish on the AI infrastructure trade for a long time. The demand keeps even exceeding those expectations. So, with that, I think any additional weakness we would be looking to lean into as opposed to viewing it as a longer term negative.
And Tim, I want to highlight another trending ticker on our site right now. We're also taking a look at Firefly Aerospace. Those shares are sliding on the company's second day of trading. It opened at $70 a share, stock now down 25%, and that's despite its upsized over $860 million initial public offering. Firefly CEO Jason Kim says the company is operational and has the U.S. Space Force as one of its clients. Tim, just talk IPOs with me for a second here. I'm curious, we just highlighted two of the popular ones from this year, right? And one trend, at least in markets recently, has been these IPOs are oversubscribed, the stock is ripping on the first day. What's that tell you about the market right now? What's the signal from what we're seeing in the IPO market that feels like it's starting to heat up a little bit?
Well, it is heating up. It's very strong. But Josh, one of the trends that we've noticed, we did a lot of research on IPOs, and we looked at every single IPO that has taken place thus far in 2025. What is the one-day price return from the IPO price, and what does it look like 3 months out? And what's so interesting, Josh, is if you look at the average, you look at the median return on the first day versus 3 months out, they're exactly the same. So you're seeing that initial pop, but you're not really seeing a whole lot after that. So it's really an important trend that I think we want to be paying attention to when we look at a lot of these IPO names. Obviously, there are outliers like CoreWeave being one of those outliers, which has had just very, very strong results overall since it IPO'd. But when we take a step back, you look at a company like Firefly, I think they're also in the middle of a very unique trend. When we look at a lot of the defense spending that is being kicked up, they won that recent contract with NASA. That's very important. I think what's difficult here, Josh, is to try to figure out what the total addressable market size looks like longer term to get an accurate valuation on it. But Right now they're in a very hot part of the market. They're leading this in a big way. So we'll have to wait and see what happens.
Definitely, Tim. We are going to have to wait and see. And you're going to stick with us, and we're going to be talking more markets in a bit here, but we're going to pivot over to an earnings story. So tariff uncertainty has been a contributing factor to recent dynamic consumer behavior, impacting sectors such as restaurants and the beauty space. Elf Beauty recently highlighting that due to the wide range of potential outcomes related to tariffs, it is not providing a full year outlook. That's as the company assesses tariff risks and looks to continue to diversify its supply chain. What does all that mean for the price-conscious consumer? Here to discuss this and more is Elf Beauty Chairman and CEO Tarang Amin. Tarang, I want to just start with the market response to what seemed like a pretty good quarter, right? You guys came out with great financials once again. It seemed like investors were hung up on the inability to provide guidance. Can you just provide a little bit more color on how you are thinking through the tariff uncertainty at this point?
Josh, thank you for having me. I'm really proud of our team. This was our 26th consecutive quarter of net sales and market share gains. Out of 1,000 cosmetics brands in the US, we're the only one to have grown market share 26 consecutive quarters. And so overall, we continue to perform extremely well. But you're right, I do think there's quite a bit of uncertainty out there, particularly on the tariff front. And that's kept us from being able to issue full year guidance. As soon as there is a resolution, we'll be happy to issue guidance. But in the meanwhile, we're going to continue focusing on picking up market share.
Tarang, I think the question there, though, is when are we going to have more certainty, right? It feels like there's been this back and forth for a while now, and I personally just wonder when it's going to end. How do you guide for that at some point? Is there an end point where you just say we need to make numbers based off a wide range of outcomes?
Well, we certainly will take a look at that. I know that the negotiations between China and the U.S. continue. We're hoping there's some resolution there. But if, let's say, there isn't resolution, then we will issue guidance based on what assumptions we're actually making. But meanwhile, I think what we tend to do is take a much more long-term view, which is we make the best of beauty accessible for every eye, lip, and face. We take seriously providing a great consumer value proposition. And so that's what we're focused on. Our business is propelled through our value proposition, our powerhouse innovation, and our disruptive marketing engine. And so we'll continue to control what we can and then adapt to what the reality looks like.
And those tariffs did lead to a $1 price hike for you guys, which is very rare across the 20 years of the company, right? You don't often do that. Is there any fear that you would have to raise prices more if the tariffs were perhaps worse than thought?
Well, as you said, we've only raised prices 3 times in our 21-year history. So we take seriously having a great value proposition. In this particular case, given the tariffs, we did announce, we're very transparent to our community across all social channels about 3 months ago that we'd be taking our prices up $1. And the reason for the $1 is in the past, we've seen consumers be able to accept $1 at a time. We're hoping we don't have to take prices up even further, but that will, of course, depend on where the tariffs finally settle up.
And how would you define the state of the U.S. consumer at this point? What are you seeing as far as trends and how consumers are willing to spend and the consistency of that?
Well, we're seeing 2 different things. Like many companies or many categories, the consumer is in a state of uncertainty with fears of tariffs, inflation, and that's certainly impacting their spend. At the same time, we continue to pick up market share, mainly because of that value proposition I talked about and our ability to engage consumers. So it doesn't really matter where the category's been. We've been able to consistently grow even through that, though I am worried about the American consumer in this state.
You are worried about the American consumer in this state, you said?
I think I am currently. I think there's still a lot of uncertainty, particularly with tariffs. And so I'm bullish on the category long term. Color cosmetics is one of the great consumer categories, totally tied to self-expression and confidence. So I like what I'm seeing in terms of our performance, but again, we'd rather have greater certainty in the future.
We're all waiting on certainty, Tarang. I'm sure it's coming at some point in the near future. Appreciate you joining us today.
Thank you for having me.
Coming up, we've got a double header playbook. We break down market pullbacks and the video game sector with some experts. Stay tuned. Taking a look at the video game industry, layoffs, tariffs, and a budget-conscious consumer weighing on the gaming space. But our next guest says 2025 is shaping up to be a solid year for video games. We're navigating how to play the sector with the Yahoo Finance playbook. Joining me now is Doug Kreutz, senior analyst at TD Cowen. He covers media, entertainment, and video games. Doug, just give me a lay of the land here when it comes to the overall video game space right now. What is the major trend that you're sort of watching in the state of play, as we do know that the U.S. consumer has sort of come into question here, right, as far as spending goes?
Yeah, I mean, the consumer may have come into question overall, but now that all the console manufacturers have reported, we know that consumer spending on console video games actually grew 8% in Q2, which was quite healthy. Obviously, Nintendo launched the Switch 2, and that helped, but spending was actually really robust on PlayStation as well. They grew 17% in constant currency terms. So while the consumer may be a little stressed overall, they seem to still be engaged in video games quite handsomely.
And Doug, the other main macro headline that the video game industry is, of course, right in the center of is tariffs, right? And what did we learn from these companies as the calls went along as far as tariff impact, and perhaps who's maybe most exposed to tariffs and where that's the largest risk?
Yeah, I mean, obviously the hardware manufacturers have had some tariff risk. I'd say thus far they've been able to navigate it pretty well. They do have sort of diversified supply chains. They all have options at least to go outside of China for their hardware, or at least Sony and Nintendo do. So they've been able to stay the course. Sony actually, in its guide in May, had sort of given a range of impacts from tariffs, and they actually walked that range down, that it's not going to be as severe as they thought it might be. As far as the video game software makers, there really isn't any impact at all. I mean, they're making digital goods, like unless you're talking like a third order impact on overall consumer spending, it doesn't affect their process at all. So it's actually a pretty good industry as far as having less tariff risk than some others.
Doug, I want to zoom in on a specific name here because this one always catches my eye because I'm a fan of the video game Grand Theft Auto, right? Take-Two. And I'm curious, GTA 6 supposed to come out next year, right? Seems like a key catalyst for the stock. But we've heard GTA 6 was supposed to come out before, right? And there's sort of been questions about when exactly is the game finally going to hit the market. Is that a risk for Take-Two looking out over the next year that this game gets delayed again, and that's something that's sort of been priced into the stock, and then that eventually ends up weighing on shares? How do you see that part of the GTA story?
Yeah, I sometimes joke that every 2 months that go by, we get 1 month closer to GTA 6. I think the May date is the real date. It has been delayed, sort of explicitly, once or twice, and I think internally it's probably been delayed more than that. This is a big game. I think they're trying to do some things that have probably never been done before in a video game, and they want to let Rockstar cook and make sure, as Strauss Zelnick, the CEO, said yesterday, it's not good enough to make good games anymore. You have to make great games if you want to be successful in the market, and he's right. But it does feel like May is the real date that we're actually going to get it and see how it is.
And Doug, we're going to go down my childhood video game shelf here. I also used to play Madden a lot, love the game, right? Of course, it's the middle of August, that game coming out. Let's talk EA a little bit here. You have a buy on the stock. You see some upside within EA. What do you think is driving that, and what are kind of the key growth drivers you're watching over the next 12 months when it comes to EA?
Yeah, so, as you sort of imply, EA is very well known for its sports titles, Madden, FC, more recently college football has been a big success for them. And that's been a great engine of growth for them over decades, and it continues to be an engine of growth. I think what's interesting right now, though, is they've got another game coming out in October called Battlefield 6, which they've spent a lot of resources in development, 4 different studios. The effort's being headed by Vince Zampella, who is one of the original developers of Call of Duty. This is a big investment for them. I think the early sort of advance notice of it has been very good. It's actually in beta test right now, and it's an open beta. It seems to be going quite well. People are excited about it. Call of Duty's a little long in the tooth at this point, and maybe not getting quite the attention from Microsoft that it used to get from Activision. So I think there's a big opportunity for EA to take some meaningful share in the shooter genre, which is the biggest genre in the video game market, at least as far as consoles and PC go. And for that to be an additional growth driver. And the stock has reacted. I think people are starting to catch on to the fact that they may have something with Battlefield that could really work.
Something we'll be keeping an eye on come the fall. Appreciate you joining us today, Doug.
Of course. Thank you.
We're wrapping up today's market domination. Don't go anywhere. We're bringing you the closing bell, and we are on record watch for the S&P 500 today. Stay with us.